To anyone involved in the property industry, it's pretty obvious that the housing market has taken a little bit of a slump over the last few months. The Bank of England putting up their base rate 14 consecutive times to a 2-decade high of 5.25% has meant that many home buyers have been outpriced when it comes to mortgage rates. Agents have subsequently complained at a huge drop-off in the number of buyers in the market, and this has ultimately led sellers with a bit of a conundrum. Sell now for a lower price or wait a little bit until the market improves. But the big question on everyone's lips is, when is the sales market going to bounce back, and how long is this property crash actually going to last? Well, there's a lot of evidence to support the fact that this property crash might continue for quite some time. In fact, it could well carry on until well into... Hi everyone, it's Sam here. Welcome back to the channel, and today we are going to be talking all about the housing market, our precious property market here in the UK. We love bricks and mortar. We think it's the best investment in the world, but it has taken a bit of a hammering recently, hasn't it? So we're going to be talking all about why that's happened and what potentially is going to be happening over the next year, maybe even 2 years, in terms of property prices. But before we get into it, please do, if you haven't already, subscribe to the channel. There are over 200 videos available for you to watch as we speak, and more being added very regularly. I am on a mission to try and get to 5,000 subscribers by the end of 2023, and I need your help to do so. Also, please consider hitting the like button, because this also helps me grow the channel too. Anyway, back to the video. So as I was saying, today we're going to be talking all about the housing market, and particularly where property prices have been going and where they're likely to go. Now, over the last 12 months, we have seen the Bank of England increase its base rate 14 times. That hasn't happened in a long time. In fact, it might have never happened before. I can't actually remember, certainly before my time being a mortgage broker, and I've been doing it 16 years. This has led to a 2-decade high of 5.25% at the Bank of England. And of course, as we all know, this has had a knock-on effect to the average price of a mortgage in the UK. And you might be thinking, that's all well and good, Sam, but what's that got to do with the price of property? Well, when it comes to property prices in the UK, it's all down to what we call supply and demand. Now, because we're a relatively small island and it's, on record that we do not have enough property available for the number of buyers that usually are interested in buying property, this ultimately leads to an upward trend in the value of property. Generally speaking, there are more people that want to buy property than there is available properties to buy, which leads to competition, which leads to people outbidding each other, which leads to rising prices. However, the number of people that are wanting to buy property is directly correlated to the availability of mortgages available to them to buy said properties. If we actually go back a few hundred years, very few people actually owned property in the UK. There are probably a few dozen landowners that, would be like, have that big manor house on a hill. They would own tons of land around, and they would rent that land for people to like farm and live on and stuff like that. And it was because at that time, there was no mechanism for borrowing money to buy land or property. So most people rented it by farming it and, supplying that particular area of certain goods. However, this all changed when the mortgage was invented, essentially a massive loan that was available to people precisely for the reason of buying a home for themselves. When this happened, obviously this meant that a lot more people had the ability to buy their own home, and we started to see this curve that has become the norm today, where property prices would continue to rise due to the availability of credit for them to buy it. Now, this mechanism really did become a lot more sophisticated back in sort of the 50s and 60s, and that is when the real massive upward curve really started. In fact, if you can remember back as far as this, back in the 80s, we had sort of a really big boom, and a lot of people talk about that being the real start of the property market that we have today. This was all down to mortgage availability, and as I said before, it meant that it fueled this, ability to buy property. The last time this was really tested was during the credit crunch, where, if you remember that far back, we had a sudden unavailability of mortgages, and this led to a big decline in the value of property. In fact, we had a recession at that point. Basically, the economy went a bit, all over the shop, and mortgages were not available, and as a result we saw this supply and demand change from there being a load of demand because of the availability of mortgages and less stock, to the other way around, where there were more people looking to sell than there were people that had the ability to buy the property because of the unavailability of mortgages. Fast forward a decade or so, and we're seeing something a little bit similar, but it's not exactly the same, okay? Because back then, the reason why people couldn't buy or couldn't get a mortgage was actually due to the fact there just wasn't the available cash around. It was called the credit crunch for a reason. Credit was not available. This time, there is loads available, but the mechanism of actually being able to lend it out has changed, and it's become more difficult to do so. This is directly because of the Bank of England raising the base rate to such an extent, because the knock-on effect has meant that mortgage rates have also gone up as well. But you might be thinking, okay, that's great, Sam, but why, if there's available credit, are people not taking out those mortgages to buy the properties? Well, the reason is they actually can't afford to do so. How mortgage lenders lend money to residential purchases is they use something called an affordability calculator. Essentially, they're going to look at your income, they're going to look at your expenditure, and they're going to work out what your surplus income is. And in that surplus income, if you can afford to make your monthly payment, they will lend you the money. If you can't, they won't. Now, if you go back a couple of years and we see mortgage rates being, quite low, on average 1 or 2%, the monthly payment on that is going to be quite low. So most people could afford to repay this in the surplus income that they had. However, with rising mortgage costs, it's meant that this same level of surplus income is unable to pay the kind of monthly payments that would need to be paid now in order to afford that mortgage. Essentially, the availability of money has gone down purely because most people, or fewer people, can actually afford to take out these mortgages. So that accounts for the demand part of this supply and demand kind of balance going down. But there's also been a knock-on effect to the supply side of things too. Because the price of mortgages has gone up, a lot more people are actually looking to sell their properties as well because they can't actually afford to refinance. A lot of people will be on 2 or 5 year fixed rates, and when you come to the end of that fixed rate, you go on to what we call a standard variable rate. Generally, that is a rate that goes up and down and sort of matches roughly the Bank of England base rate. So as you can imagine, they're quite high at the moment. These people would have been on 1 or 2% residential mortgage rates, and suddenly out of nowhere, their cost might have doubled, tripled, or even quadrupled overnight. Now you might be thinking, okay, great, Sam, why don't they just remortgage? Well, if we go back to what we were saying previously, because rates have gone up so high, they might not be able to afford the amount they would have done previously because the rates have gone up and their income hasn't. As a result, a lot of people might be forced into selling their properties as the only way of getting themselves out of this predicament. Added on to that, as we said before, it's all about affordability, so its income might have stayed the same, but people's expenditure recently, as we all know, has gone up dramatically because of inflation. So if their income stayed the same, but their expenditure has gone up, what do you think that's happening to their surplus income? It's gone down, but that surplus income has got to pay for a higher mortgage payment. So this is all basically a downward spiral that's leading to a lot fewer people being able to afford mortgages, both in terms of buying property and refinancing property. And this is why we are in this state of affairs as we are at the moment with the property market, seeing a big dip over the last few months. So for the property market to get back on track, we basically need all those things to reverse. But what is the likelihood of that happening over the next few months? Well, at the time of recording, the Bank of England's base rate is 5.25%. And there are a lot of people out there saying that realistically, we can't go that much higher than that. So we probably have reached roughly the top of where the market is. Potentially we might get to 5.5%. At the time of recording, the Bank of England's Monetary Policy Committee are actually meeting tomorrow, Thursday, the 2nd of November, and they're going to decide whether the rate stays the same or goes up. It's not going to go down. Now, we need the base rate to come down, so mortgage rates come down, so they become more affordable and more people can afford to buy and less people are being forced to sell for that supply and demand to come back to normal. But the base rate coming down will be based on whether inflation comes down. At the time of recording, it's 6.7%, and that has been the same for 2 consecutive months now. Previous to that, we only had a slight decrease of 0.1%. This isn't really where most people were predicting inflation to be at this time. In fact, at the beginning of the year, Rishi Sunak, our Prime Minister, predicted that we would get below 5% by the end of the year. Now, as we've just gone into November, getting that rate of inflation down below 5% by the end of the year is looking increasingly unlikely. The message that is sending the economic community is that the Bank of England are going to be either forced to increase their base rate again or at least keep it the same for a much more prolonged period of time. A month or so ago, I was predicting that I thought the base rate might start to come down at the beginning of sort of quarter two, so going into sort of April, May 2024. But because of the rate of inflation staying the same, I think this is going to happen a lot later. Realistically, for the Bank of England to reduce their base rate or start reducing their base rate, I think that inflation needs to be at around 3.5% or maybe even below 3.5%. Until we reach that point, the Bank of England are going to maintain this course of keeping the base rate high, and the longer the base rate is high, the longer mortgage rates will remain high. So if inflation is being a little bit stubborn and it's actually not coming down, what is that going to do to our property market? Well, it just means that what's happening right now is going to continue happening for a longer period of time. Now, it doesn't necessarily mean that property prices are actually going to completely crash, but it just means this decline and this stagnation is going to remain for a longer period of time. We also have to remember that at the moment, with the base rate being at 5.25%, just one little decrease is not going to make a huge impact to the market. In fact, we're probably going to need about 0.5% to 1% off that base rate for us to start seeing a big impact on the average mortgage rate in the UK, which will then have the knock-on effect for more buyers being able to come back into the market and start buying again. So we're not just trying to predict here when the Bank of England is going to start reducing its rate, it's when it's going to get to the point where maybe it's around the 4% mark, because until it reaches that point, I don't think that mortgage rates are going to be at a level where the mass market is going to be able to return to buying property and affording mortgages. So when is this likely to happen? Well, the bad news is it might be really going into 2025 until we get the base rate down to this level, which means we've got another 12, 13, 14 months ahead of us of this type of property market. And if things carry on the same, we are going to still see a decrease in the value of properties, I think. So that's what I think, but I'm really interested to know what you guys think. Let me know in the comments, do you think that the base rate is going to go down over the next 6 months? Do you think the rate of inflation is going to go down over the next 6 months? And when do you think the property market is going to start bouncing back? Let me know in the comments. I'll be really interested to hear what you think. Now, if you like this video, and I hope you have, you're probably going to absolutely love this one here. YouTube is recommending you another one of my videos right now. So hop over, enjoy, and I'll catch you over there.